The Federal Reserve, we've gone from QE, quantitative easing, to quantitative tightening. So going from buying assets, buying bonds, mortgage-backed securities, bunch of treasuries. Now the Federal Reserve is selling that. They're liquidating parts of their balance sheet. Kind of a portion at a time. They're going to be ramping up how much they're going to be selling. A lot of treasuries as well as some mortgage-backed securities. To me, Matt, it was crazy to think that in a high inflationary environment where the housing market is going gangbusters, where they were still adding extra liquidity into the system, not too long ago.
Yeah, I thought their timeline for this was I don't think overly generous. I don't think that the markets are really reacting with like fear or horror. If anything, it seems like they're ready for a little more tightening.
Yeah, I think this has been pretty well kind of signaled and communicated that this was going to be the case. This is what's happening. Don't need to go into all the details. But yeah, QT may add to upward pressure on real yields, as according to Wells Fargo, their investment institute. So I think the question here is, without the Fed again continuing to pump liquidity into these markets, being a buyer of these bonds, which is going to lower the yield and raise the price. Now we're seeing the opposite. So we should be seeing yields rise as they're selling. We should see yields. We've already seen interest rates rise. The question is, now that the biggest buyer of these treasuries and mortgage-backed securities has left the market and is actually selling into the market, are we going to see an further increase in rates beyond what we've seen today? Because, rates are, still, real yields are still quite negative. Even as they've risen, they're still not, even where they were in 2019 levels. And with inflation, hovering around 8% or so, they're grossly negative. And I think a lot of people are wondering, when the kind of the 10-year is going to start getting closer to the actual inflation rate.
Yeah, I was just talking about that, about these situations where you buy an asset and you don't get any income from it, and you have to wait till you sell it. You may make a lot of money when you sell it, but there's some strangeness there.
Yeah,
and I think a lot of people now are used to it. They'll get maybe a crypto coin, and that's not going to give them any income.
That strategy is what's really is shifting. Because that's been the trend. What has been the trend of we'll just bet on future growth. Because there's not that much inflation in the economy, and whatever amount that growth value is going to be worth significantly more. But now, since the dollars in 5-10 years are going to be worth less, if we have a high rate of inflation, that growth is significantly discounted. And so we're seeing investors kind of across all asset classes looking at assets that are producing income today, generating a return today, rather than speculating on a return, years down the road. And that's where, dividend producing stocks are becoming more popular, value stocks. But then in real estate, just as a whole, as an asset class, becoming more popular because it's, inherently, usually income generating. But even inside the real estate world, we're seeing a shift from markets and strategies that are much more focused on long-term growth potential, cap rate compression, that maybe not be throwing off hardly any cash, to now to strategies that are throwing off, relatively much more cash flow or some cash flow, relatively moderate cap rates. And that's where we're seeing, a rotation, into the Midwest, into some more of the secondary and tertiary markets in the Sun Belt in the Southwest. Folks that are really kind of chasing yield, because again, if your apartment community is only earning, if your investment in multifamily deal is only earning, 4 or 5%, you're losing 3 to 4% on a real basis, at least on cash flow, to inflation. Now there's other, you're paying down the mortgage, there's other return metrics that allow your return to be actually positive, but you have to question yourself if inflation's at 8% and your investment's only putting off, 4 or 5.
Yeah, it is interesting. I think that this was getting my head into like the multifamily world. There was a lot of markets that were growing. And if you had projected the same kind of growth from 2021 into 2022, you'd have a problem no matter if the Fed had tightening or not. There's just some of that growth was unsustainable. And then you add to that math that doesn't work from the perspective of getting a loan versus, that balances with your yield. Then you're really counting on, some of them, I bet that there were some of them that were underwater in the sense that they, the yields were negative.
Yeah.
Not
yeah.
underwater in terms of
well,
debt,
but they're using, but to your point, Matt, a lot of groups now are using negative leverage.
Yeah.
And so really that debt isn't really helping you return that much until you grow out of it. And
Yeah.
that's where a lot of people are saying, we are growing out of it. We can grow out of it. It's just how much time and how much you want to speculate on your ability to grow out of it. Because just what you were saying, if you use some wrong assumptions and you assume too much growth for too long,
Yeah.
you don't grow out of it.
And I think that this mortgage thing could be a real big mover in terms of like a wake up call. Instead of their projections, having something that's near term, those loan payments, that's a real thing. That's not just
starts
a
right away.
Hypothesis, because there still could be the growth there, but when you're facing such a sharp shift, then that could move people a lot more than maybe a slow changing circumstance in the hot markets.
Well, as they say, as the tide goes out, you can see, really who's swimming and, who doesn't know how to swim. Because it really exposes who's doing real deals and who's just been doing deals because, an insane amount of growth, but just artificially low interest rates that you can make just about any deal pencil buying at a low cap rate. But now who's actually doing good deals? And there are still good deals out there. You can still finance a property. You just have to do it the right way.
Yeah, that's a really good point. And I think you said that like months ago, how some people they may not have done all of their due diligence, but they're still making a lot of money because the market was so great.
Yeah, you can buy anything. Yeah.
Now skills have more of a premium and experience and making those good decisions.
Yeah, I agree. And it was difficult because things are moving so fast, and so there was this like decoupling from like any kind of fundamentals or like buying under replacement costs. Was people didn't know what replacement cost was, and prices were moving so quickly. There was a lot of deals that were trading well above replacement costs that didn't make too much sense. Other than if you could get an incredibly low interest rate, you could make the numbers work. But are you really making a good buy on fundamentals?
Yeah.
And I think one of the more refreshing things to all this kind of uncertainty and madness is, in a sense, it's sort of a return to some degree of kind of economic fundamentals, because it's like all of a sudden these things actually do matter.
I was going to say now we have consequences.
Exactly.
And I always thought too, in general, that that at least a lot of the the stories that you have when you're making the deals, it's not like investors were gobbling things up. They were still using they were still going to math, but like the numbers kept creeping up, and it just seems so unsustainable.
Yeah, I think there's a degree of FOMO in 2021 also. People not doing deals in 2020, and then once everyone saw these made big headline rent growth numbers and cap rate compression, everyone's like, we got to get in because I want to lock in this cheap debt. And there were a lot of good buying opportunities if you could lock in some incredibly cheap debt. But I think it kind of put a fog of war out there. You weren't really sure what you were buying.